Hi there. So I just wanted to talk a bit about a course I went on recently. The course was by someone called Kevin Wright, and it was about property finance. It was about how to buy property with the intelligent use of bridging finance. And I found it very interesting because it opens up lots of new possibilities for buying investment property without using a mortgage. Now, I know that there are other ways people do this. For example, people use joint venture finance, or people buy property on options, or maybe they have a large pot of cash and they can use that. But this just gives an alternative method because it's always good to have more choices when buying investment property. So what I found really interesting is actually that there's 5 different types of bridging finance. The first is called a purchase bridge. Now, this is where you just buy an investment property and the bridge is secured on the value of that property. So supposing you buy a property for 400,000, normally the bridge is secured at 75% loan to value. So you'll be able to borrow 300,000 and you put 100,000 of your own money in. So it's a bit like a mortgage. Obviously, bridging finance is a lot more expensive than a mortgage, but it does have some advantages. For example, it's a lot quicker. You can complete on a purchase in less than 28 days, which is a lot less than if you use mortgage finance. Also, maybe you are unmortgageable, or maybe the property is unmortgageable, but you'll still be able to use a purchase bridge for that. So that's the first type of bridge. The second type of bridging finance you can use is called a market value bridge. Now, one of the problems with using mortgages to buy property, if you're a property investor or property trader, is that a typical buy-to-let mortgage, they will lend on the lower of the market value of the property, or what you paid for it. So for example, if the property is worth 400,000 and you buy it for 300,000 pounds, the low of those is 300,000. So the buy-to-let mortgage will be on 300,000, even though it's worth 400,000, and they'll give 75% loan to value. So they'll actually lend you 225,000. So even though you bought it massively below market value, you would still have to put in 25% deposit on what you paid for it. So in that example, you'd have to put in 75,000 deposit. Whereas if you did it on a bridge, you would you don't have this lower of market value and what you paid for it. They would just lend on the market value. So the market value in this example is 400,000. They would lend 75% of that, which is 300,000, which is what you paid for it. So that would be a no money down deal. You borrow 300,000 and you buy it for 300,000. So this is the magic of bridging. And if you start to focus on things like the return on your investment, or the return on your cash tied up in the deal, or look at your internal rate of return, you can see that using this bridging instead of mortgage finance can massively increase your return on your cash, if done intelligently and if you have the right deals. So the third type of bridging is called a refurb bridge. So this is where you sort of buy a property that needs refurbing, or you could add value in another way, like get planning permission, or you could extend the length of the lease. So in this case, you buy the property, you get 75% of the value of the property as a bridge. So you still have to put in a deposit, but then your refurb costs, you could get 100% of those refurb costs financed by a bridge. So, and this, you would get the money, the bridging finance for your refurbs in arrears, but you could do it in tranches. So if you're doing a lot of work, you do a bit of work, someone comes around and inspects it, and then you get a tranche of money, and then you could do that several times if it's a big refurb. But it's a way of financing refurbs if you have limited cash. A fourth type of bridge is called a done-up value bridge. So this would be using an exchange and delayed completion. So you would exchange. Now, when you exchange, you sometimes have to put in 10% deposit, but this is not set in stone. You could agree with the vendor for it to be less than 10%, or so it could even be zero. Well, it could be a very low deposit you put on the property. Now, if you pull out of the deal, you would have to pay a 10% penalty because that's enshrined in law, but you don't necessarily have to put that down as a deposit. So exchange on the property with minimal deposit, hopefully. Then you add value, which could be a refurb, planning gain, or extend the lease. And then when you complete, you would be able to use a done-up value bridge, which means that you get the bridge based on the done-up value, which is the market value after you've added value. So again, the only money you'd have tied up until this point would be the money you've spent on what you've done to improve the property, which would be refurb, planning, or extending the lease. And then if you've added sufficient value to it, then this again could be a no money down deal, because you'll be able to get to bridge 75% of the done up value. So now in any of these scenarios, you could either refinance the property on a cheaper mortgage if you wanted to keep it, or you could flip it. Now, the fifth type of bridge is called a cross-collateral bridge. Now, so a lot of these scenarios I've talked about, you've had to put some cash in. But maybe you don't have much cash, but you do have a lot of equity tied up in your property. So in that case, suppose your property is unencumbered, you could use that as security for a bridge, 75% of the equity of your value of your property. If you do already have a mortgage, a first charge on your property, supposing you have a 50% loan to value charge on your property because of the mortgage when you bought it. Now, a bridger could then do a second charge, but up to a total of 65% of the loan to value of the property. So if your first charge is already at 50%, then there's 15%, total of 65% minus 50% equals 15%. So they would lend you 15% of the value of your property you're using as cross collateral, in addition to the bridge that they're paying on the asset that you're buying. And also another great thing about this is that the cross collateral bridge, a security, it doesn't have to be your own property. It could be a friend, relative, or business partner, their property, as long as they sign the bridging contract and come in there. So it's a way of doing deals using equity in properties, which would equity that you might be unable to remortgage and access that equity in any other way. This cross-collateral bridge you can do in combination with any of the other four types of bridge. So I just wanted to give you a flavour of the magic that can sometimes happen using bridging finance. It's a bit complicated and it can be expensive, but but then you could also ask, compared to what? Because it does mean that you'll be able to access finance you would not otherwise be able to access, which means that you could do property deals that you're otherwise unable to do. If you've got any questions, type them in chat. Otherwise, it was great. It's great talking to you. This is the first actual live I've done for some time, but I hope to start doing them again soon, because I hope to start interviewing people again. And from now onwards, I think my my main focus will be property, because I do think that is the very best way of becoming financially free, by leveraging finance and the growth in assets over time, and also the intelligent use of good deals and buying the right type of property. I think there's lots of different, and also leveraging other people. There's so many, if you know what you're doing, I think you can make a lot of money in property, either by just doing things really cleverly, or just buying and holding. But the magic of time, I think, will mean that over time, property will inevitably increase, and whereas your loan is fixed in money terms, so it's sort of got built in that inevitably your equity will go up over time, and therefore your wealth. So I think it's a great strategy to become financially free. So I'll be talking to many people about that, what strategies they use, and how they've become wealthy themselves. So that's all for now. I hope to see you all soon, and bye for now.